NIDS were originally made available in 1961 by originally National City Bank of New York, which is now Citibank. The technology allowed banks to raise capital for lending. NIDS were developed to assist banks that have been struggling for 10 years due to a deficiency in deposits. Many customers of banks switched their funds from checking account to other investments such treasury bills, commercial paper, and bankers' acceptances in order to earn interest. The First National City Bank of New York provided a $10 million government securities loan to a New York broker, which consent to a permit trading in IDS. A secondary market where the NIDS could be traded was created as a result. By 1966, investors had $15 billion in NIDS in circulation. The amounts rose to around $30 billion and $19 billion respectively in 1970 and 1975. The market for NIDS is dominated by wealthy individuals and institutions, including companies, insurance companies, pension funds, and mutual funds. The market attracts investors seeking a return on a liquid, low-risk investment. Mutual funds pull the money from shareholders to invest in securities including stocks, bonds, money market instruments, and other assets. Mutual funds are managed by professionals who allocated the assets in an effort to increase investors' capital gains or income. A mutual fund's portfolio is constructed and maintained in accordance with the stated investment objective in the prospectus. Through mutual funds, small or individual investors can access professionally managed portfolios of stock, bonds, and other instruments. Each shareholder thus receives a proportionate share of the fund's gains or losses. Mutual fund success is normally measured by changes in the fund's total market capitalization, which are determined from the performance of its underlying investment added together. Mutual funds invest in a vast variety of assets. Many mutual funds are owned by a larger financial organization, including Fidelity Investment, Vanguard, T. Rowe Price, and Oppenheimer. A mutual funds fund manager, also referred to as the investment advisor, is obligated by a law to operate in the shareholder best interest.
Negotiable instruments are essential for facilitating financial transactions and ensuring trust between parties. These legally binding contracts outline the obligations and responsibility of both the payer and payee, eliminating ambiguity and promoting timely transactions. Their unconditional nature simplifies the process, allowing holders to transfer instruments through endorsement. Endorsement signifies indebtedness and grants the right to reclaim the specified sum from the instrument's manufacturer. Legal notes are a secure and efficient method for transferring funds and eliminating the need for physical currency. They facilitate seamless financial interactions and ensure transparency by including the assigned name, preventing unauthorized access to funds. The agreement should spell out both parties' rights and responsibilities, address any possible disputes or conflicts, and include a resolution mechanism like arbitration or mediation. It is best to contact legal specialists and follow applicable rules and regulations to guarantee enforcement. Parties can form a complete and legally enforceable agreement and protect their right and promote seamless transactions within the scope of the UCC. Endorsing a check and transferring it to another person should be done with caution, ensuring it is transferred to someone trust and keeping track of its progress. In case of issues or concerns, contacting your bank for assistance is recommended. Checks are a convenient way to transfer money, but proper handling and security measures should always be followed to protect both the payers and payees' interests.
First and foremost, the benefits which are valid for settling claims in international trade. Importers of various countries use this option to clear their financial obligation. For example, bills of exchange function as a written order used primarily in international trade that binds one party to pay a fixed sum of money to another party's demand or at a predetermined date. Liquidity and credit creation are also the benefits of investing in negotiable instruments. By providing a means of generating credit, negotiating tools increase liquidity. By leveraging the value of the instrument, they make it possible for both businesses and individuals to acquire capital. For instance, a company can increase the amount of money it has available for investment or working capital by borrowing money from a financial institution using a negotiable instrument such as a promissory note. Credit creation is the borrower's account that gets credited with the loan. For each bank loan, an equivalent deposit is made in the bank. Therefore, the expansion of bank deposits is a result of credit creation. This process of credit creation allows businesses to access funds that they can use to expand their operation, invest in a new project, or meet their financial obligation. Similarly, individuals can also benefit from credit creation as it enables them to obtain loan for various purposes such as buying a house, starting a business, or funding education. Overall, credit creations play a critical role in facilitating economic growth and providing opportunities for both businesses and individuals to access the capital they need. The benefits of investing in instruments are more safety and security. In financial transactions, negotiating instruments provide a high level of safety and security. They provide legal safeguards and enforceability, guaranteeing that all parties engaged in the transaction are legally obligated to meet their agreements. This reduces the chance of payment default and increase confidence between the parties involved in the transactions. Negotiable instruments are frequently used in business transactions because they offer a practical and effective way to transfer ownership. Parties can exchange value quickly and securely without the need for laborious legal processes. Additionally, the legal protections that are frequently attached to negotiable instruments add to their appeal in commercial transactions. The benefit of investing in instruments also include convenience and flexibility. Negotiable instruments offer convenience and flexibility to financial transactions. They can be customized to meet the needs of the parties involved by setting payment terms, maturity date, or other requirements. Furthermore, because they are easily transferable, negotiable instruments enable parties to modify their financial agreements as circumstances alter. Instruments that are open to negotiation are more flexible than those that are not, which are rigid and prevent contract terms from being changed or modified.
So the characteristic of negotiable instrument of deposit. A negotiable instrument of deposit is a financial instrument that reflects a monetary claim and can be transferred by negotiation from one party to another. So for document, I have checks, promissory notes, and certificate of deposit are examples of negotiable instrument of deposit. First characteristic is a negotiable. A negotiable instrument of deposit is the most important feature, and this indicates that another party may acquire the instrument and become the new holder in due course and have the same right as the previous holder. The second characteristic is the transferability. A negotiable instrument of deposit may be freely delivered from person to another. Endorsement is the act of the present holder of the instrument signing or stamping the document to express their desire to transfer ownership to a different party. The next is an unconditional promise. Unconditional promise is to pay a certain amount of money. This pledge or instruction must be unequivocal without any conditions or limitations. So the next characteristic is a fixed amount. These have a definite and determinable due on it. So both word and number should be used to convey it in the instruments, and any conflict between the two should be typically be resolved in favor of the amount expressed in words. So for the next characteristic is a payable on demand. A negotiable instrument of deposit may be payable either on demand or open demands. So which case the obligation to pay is immediate. If a payment is due at specific date, it does when that day or times arrive. The last characteristic is a legal recognitions. Negotiable instruments of deposit are recognized and regulated by various laws, such as Uniform Commercial Code in United States. These laws establish a framework for their development, disseminations, and enforcement, ensuring their dependability and applicability in business dealings.
The negotiable instrument of deposit or NIDS maturity is from 1 week to 5 years from the date of the issue. NIDS is not insured by PIDM or Perbadangan Insurance Deposit Malaysia. If the NID is kept to maturity, the bank will guarantee the principal amount. A certificate of NID will be created for each NID transaction and on the transaction start date. The bank who act as the investor's official depository will keep the custody of the original certificate and save it electronically. On the start date of the NID, investors are going to receive a confirmation letter in the mail with information about the transaction, including the term, maturity date, rate of return, nominal amount, and the NID certification number. For the interest payment frequency, there are two kinds of NIDS, which are short-term NIDS and long-term NIDS. For the short-term NIDS, the interest upon maturity is where the maturity is less than a year, while long-term maturity, the interest payment is half a year or annually and the maturity is more than 365 days. Then, to calculate interest proceed, you can use the interest proceed calculation for short-term and interest proceed calculation for the long-term.
Based on the study that our group have made is about negotiable instrument of deposit, which is NIDs. A negotiable instrument is a written document that guarantees the payment of a certain of money to the bearer or the designated recipients. Based on NIDs, people and institutions, including businesses, insurance providers, pension funds, and mutual funds, are the main participants in the market for NIDs. Other than that, these legal notes acts as a secure and efficient method for transferring funds, eliminating the needs for physical currency. Negotiating tools boost liquidity by giving a mechanism of producing credit. They enable both enterprises and individuals to get capital by leveraging the value of the instruments. The maturity is from 1 week to 5 years from the date of the issue. Typically, interest is paid twice a year or at maturity or the instrument is purchased at a discount to its face value. Interest rate can be negotiated, and the yield on an NIDs is determined by money market condition.